So first thing I'm going to do is going to look at our calendar. We're starting a brand new year. We knew that this week would be a positive week. This is called the Santa Rally, and it basically went up 1% this week. Next week, well, we're an extreme overbought situation with our S&P. If we look at the S&P, you can see that we're way above we've been overbought since beginning of November. So that is a super bullish. That means people are super excited and they want to buy. And right now, that's the situation is that you have to think the other side. As soon as everyone is done buying this week, we start the beginning of next week, which is the new year, and there's a good chance we'll be selling off and going back to an oversold situation. So this is not the time to buy. This is the time to not sell or to sell. I mean, not buy or to sell. All right, so if we look at some of our meeting notes. First of all, okay, we have a holiday coming up, the 4th, New Year's Day, and we have another day coming up in the 15th, which is Martin Luther King Jr. Day. So, but we expect the first week of January to be giving back some of the gains from the rally from this week. And then we'll start earnings season. And February is usually a bad month. Let's look at the whole calendar. We know that February is one of the worst months of the year. It's and then we have March and April and May are usually good, and that's usually because the East Coast, where most of the traders are, it's better weather, and a lot of times that has an effect on people's attitude. Now, let's look at some of our talking points for this week. We do have momentum in the stock market. We have 88% of the S&P above the 50-day moving average. 76% was above the 200-day moving average. That is a sign of momentum. So right now there's a lot of people that are excited and want to buy, and I think a seasonality is a self-fulfilling prophecy of this last week of the month being the Santa Rally. So that is all happening at one time. We have a combination of the Fed done raising interest rates, and they hinted at 3 cuts next year. So this is all really good for the stock market. The companies with high debt ratios are starting to rally, and the companies that did worst for this year are now doing the best. So we still have the dollar, it's falling, so that's good for our stocks. This week we had the treasuries go down another 1% to 2%. So 10 years down 1.2%, and the 2 years down 2%. That is really good for smaller stocks, any company that needs to borrow money. You see. And let me see. All right, so let's talk about that. So right now we're still in an overbought state. So right now the Stochastics isn't really helping us much in making decisions whether to buy or sell. Everyone's just buying. We look at our chart of the U.S. Treasuries. There's still an inverse correlation. This is still working. As the Treasuries are going down, the stock market is going up. So we went up another 1% this week. So that was a nice thing. This is a nice little correlation. I'm not sure how long it's going to last though. Over time, this doesn't really match up other than in recent times. Let's look at some of the variables in the stock market. The price of oil was down is down to $72 a barrel. That's usually an indication of either oversupply or weak demand, and it's probably a combination of both. And weak demand is an indication that there could be a recession coming. So we work that into our calendar, and as a probable situation. Let me see. And all these other parts of all these other variables aren't changing. Inflation is the same. It's getting better over time. The U.S. dollar hasn't changed this week though, and gold is up 1%. All right, fear and greed. We are actually in extreme greed this week. Last week we were at greed. That means that people are overexcited. This is not the time to buy. You have to think contrarian when you're investing. So right now everything is pretty much overpriced and extended. So it's very difficult to invest right now if you're trying to get in. We have complementary sentiment survey being bullish for the AAII. So usually when the AAII people are bearish, that's the time you buy. Right now they are excited and buying. So U.S. dollar continues to go down compared to other currencies. So that is good for the multinational stocks. So we expect the first quarter of January of next year to be good because for a lot of the tech stocks because they do a lot of business overseas. And so I guess a lot of the top 7 stocks do like half of their business overseas. So that's going to be really good for their earnings reports. Right now the VIX is down to 12, and that is a indication that people aren't afraid. So we have all these indications that people are excited and buying. I'm expecting that to switch around towards the beginning of the year. We have to give some of this back, and we see this is a good time. People are moving money around. There's a lot of beginning of the year tax loss selling and taking gains, etc. that has to be done, and that a lot of times that happens the first week of the year. So but January is a good month, so let's keep that in mind too, seasonality wise. Okay, so now let's look at our investor sentiment chart. Right now, where everyone is super excited, and it's on the front page of every newspaper that the stock market's going up. That's the time you don't buy. That's the time that you hold what you have or don't buy. And all these issues that we've thought might be giving us a crash are not really coming to fruition. The only big problem right now is the U.S. Treasury and the debt of the United States. That could mess up our whole situation with our dollar. So if our dollar continues, if we have hyperinflation or some kind of continued inflation due to our debt, the value of our dollar isn't going to be great anymore. So other than that, everything else seems to be under control. We have AI stock bubble. It's not really bursting, and people are still excited about those stocks. We have consumer debt. It's getting worse, but it's not unmanageable because people are still spending. Interest rates are coming down, and that might fix some of the commercial real estate problems. And gas prices are going down too. That'll help inflation. So it seems like all the known issues that could take us to a capitulation are not coming to fruition. So that's good. I updated this chart. This is right now we're at 4% in the Treasury, around 3.8%. So if you see this line right here, I'm looking at what people have paid in the past for stocks, the PE ratio, whenever the U.S. 10-year Treasury is at 4%, and that is around 15. So we're right around 20 right now. So that's a 30% difference. So if we were to revert to the norm, the S&P would be trading 30% less than it is now, for 4%. Now, if we went to a 2%, then we'd have a situation where people will be willing to pay 20 times earnings. So as the 10-year goes down, people pay more for the S&P 500 price to earnings. So let's look at some more screens. We're keeping in mind this worst to first chart. The worst stocks in the worst sectors of the year for this year. A lot of times they revert and become the best of next year's. And but I'm not selling I have a big technology part of my portfolio, but I'm not selling that because they're still growing. And it just sometimes you revert to the mean, and the stocks that did good last year will underperform this year, and vice versa. So we're going to keep our eyes on these sectors as we go through the year. Let's review the themes for next year. Next year, we're going to have 3 interest rate cuts at least. And mortgage rates are going to be going down. Housing, people are going to be excited about buying housing. And there's a chance we could have a recession. And if that happens, the stock market's going to go down because most stocks go down in a recession. And if they do go down, we'll go up again right away. So I wouldn't worry about that. Let me see. So oil goes down in a recession. So if you're interested in energy stocks, be ready for oil to go down lower than it is now if there's a recession. And investors will be reaching for yield and stable businesses. So all these stable businesses that you have a high yield and are predictable in their earnings, they're going to be in demand in the coming year. And the banks will benefit from the interest rates going down. All right, let's look at the next, let's look at some of the sectors that are doing good and the bad in the stock market right now. Okay, so we'll look at the sector ETFs. And the ones doing the best right now are, look at that. So if you look at our best to worst, the ones doing the best are the ones that did worst this year. So you had real estate, they did bad because interest rates were going up. Utilities going up, and that's like the opposite. So let's keep our eyes on this because that's very good. Real estate, financials. We see financials. You see all the ones that underperformed last year are outperforming in healthcare. So it's a total reverse. And then we have the worst sectors of today are energy, oil, and gold miners. So that's very interesting. That was a good exercise. I'm glad we did that. And next thing is we have, let's look at some of the best and worst stocks in the stock market right now. We have, never heard any of these. Okay, we don't have them. Okay, we have Match.com. We talked about this a couple of weeks ago. Let's look at it just for fun. Match.com is they're growing, they're undervalued right now, but they have a lot of debt. So we have to look at that stock, MTCH. Okay. We have to look at this stock in relation to, we look at statistics. We'll see that the PEG ratio is 0.49. That means it's half undervalued. Its PE currently is 14. So, and it's currently grown around 14%. But the problem with Match is that it has a lot of debt. So this $3.9 billion in debt out of a $9 billion company. That's half its market cap in debt. So as interest rates go down, stocks that borrowed heavily to grow to where they are now are going to do better because the interest rates are going to be lower and they can borrow at a lower rate and refinance that. So you see, it looks like we have, let's look at what else. What else can we see with this? We see AMD. They were going up recently because they made a new AI chip. We have Warner Brothers Discovery, Nike, and Pinnacle West. I don't see anything common between those. The ones losing the most are real estate and banks. All right, so let's look at some more of our talking points. Okay, so our talking points are, okay, we have a lot of time this time of the year, we have people prognosticating what's going to happen next year. And there's an article right here that says why 2024 will be a surprisingly good year for stocks. And the CFRA, they're a really good company of understanding how much the stock is worth, and they give good reports. And the main chief investment strategist says next year will be a surprisingly good year. It's an election year, and a lot of times around election years, you have positive historical returns. And he agrees right now that we have overbought conditions. I've been saying it's been super overbought for 2 months right now. And so that could spur pullbacks. That's why we're saying we're overbought right now. Maybe the first week in January, we're going to go down. He sees no real fear of a bear market. He says any sell-offs will be followed by a rally. But he says whenever the Federal Reserve cuts the rates, that could lift the valuations across the assets. And that's kind of what we were saying with this little chart here. As this the rate of the 10-year goes down, the amount people are willing to pay for the S&P price to earnings ratio goes up. So he's agreeing with that. And let's look at what else. He said, let your winners ride rather than buying last year's losers. So I'm letting my winners ride. I'm not rotating into the losers from last year, but you're going to have a bounce back. And that's why we have some of the sectors outperforming now that we're bad year to date. He expects the market to advance 14% in next year. And that'll lift all boats in terms of size styles. So it should have a broad market rally for this lowering interest rates. He says the financials are one of the groups that will outperform because they do better when interest rates are lower and the yield curve is better in their favor. And real estate does better whenever the interest rates go down. So that matches our real estate and financials are two underperforming this year. He didn't say utilities yet, but let's say what he says. He says that following a down year, you want to buy last year's losers. That worked this year. But following an up year, like this year, you want to let your winners ride. So that consumer discretionary, communication services, tech, but all, he said you have to let your winners ride. So even though these ones underperformed, even after a good year, these ones will do well also, but maybe not as well as the other ones. So that's not why, but that's another good reason why to buy and hold. And let me see. Here's another here's a little story about how someone predicting what's going to happen next year. There's a guy named Tom Lee. Everyone thought he was crazy when everyone was predicting a recession for this year, and he said we're going to have a really good year with 20% S&P performance, and he was right. He was within 1% of its current level. So what he says is the lower interest rates is going to be the key driver of stock market gains. So this ease of financial conditions throughout this year is going to help the stocks. And he said the lower mortgage rates is going to revitalize the housing market, and it'll loosen the lower interest rates will loosen financial conditions, allow consumers to spend money. So he's predicting 11% growth into this year. So he thinks the S&P is going to be at 11% higher than it is now. But he still expects the S&P to expand their multiple to 20 times. So he thinks small cap stocks should do well this year. That's because they need to borrow money, and the lower the cost of capital is, the better they'll do. He thinks small caps will go up 50%, go up 50%. They were down a lot this year, one of the worst performing sectors. So he also likes financial, industrials, and technology. Let's see how he likes financials, industrials. Okay, so that's a lot what worked this year too. Okay, so industrials and financials and tech. All right, so he's been right. Let's see if he's right for next year. Another guy, a guy named Jeremy Siegel from the Wharton Business School. He's been saying a long time that inflation has been under control and that the Fed should stop raising interest rates. So he thinks he mentioned that the S&P is already trading at 15 times if you take out the top 7 stocks. So it's basically, without the top 7 tech stocks, the S&P is closer to 15 times, and that's the value. And he says a value stock should outperform growth stocks this year. But he says there's no sign that there's going to be a recession, and he's like an economics professor, so he knows these things. Okay, so he said the Fed was stubborn. He was always predicting that the Fed was raising too much too fast, and now he's saying they should reduce it. That his biggest concern is they don't go down fast enough in the interest rates. So he thinks the S&P can go up 10 to 15% in next year, and houses prices could rise too. And he thinks inflation should be around 2.5%. So this is all good for stocks, if he's right. So that's always good to keep in mind from different people's opinions on this. But you ought to take the other side too, is that stocks don't grow to the trees, and you're going to have a pullback too eventually. This guy, Dougie Cass, said he doesn't like the idea where everyone's saying the same thing, where he calls it groupthink. Last year, at year end, he said everyone was bearish and thought it would go down this year in a recession, but it didn't. And he likes to do the opposite. I'm trying to think like him too. That right now he's making fun of Goldman Sachs, and all these people are saying everything's going to be great next year. And right now the consensus is for the stock market to go up next year. But if you think the opposite, the consensus is we're going to be great next year. The contrary person will say, there's a very good chance we have a recession, and you got to not pile into what worked this year. So I'm just trying to train everyone to how to think opposite and as a contrary investor, and to see the other side of things, just so you don't get over your skis. All right. So this is an article that mentions the Santa rally. It heads for the 8-year winning streak. So the last 8 years, you can see we've had a winning week. Right now it's up 1% this week. And let's hope it continues. It doesn't work every year. You can see some years it doesn't. But we don't know why it happens, but there's a lot of seasonality involved, a lot of repositioning, a lot of people trying to get in on the best stocks of the year. And so right now the Santa Claus rally is the last week. Let's look at our calendar. Santa Claus Rally. Last week of the year, we had 2 holidays, Christmas and New Year's, and people get excited around those times. So right now, then after that, we have a hangover, I guess. We have the stock market usually going down after being excited for so long. And so it looks like it worked out this year, so that's great. But this week isn't over yet. Okay, so here's another article I got from Yahoo Finance. Boeing, FAA urged operators to inspect 737 MAX jet for loose bolt. Boeing has a hard time with quality control. I mean, they don't have a problem selling airplanes. They've sold airplanes 10 years out. So they can sell the airplanes, but they can't make them without quality, without defects. So that's their biggest problem right now. If we look at the earnings chart, I actually mapped out the earnings chart for all the stocks we're following this week. Let's look at the earnings chart for Boeing. Hold on, we'll get there. It's worth it. Boeing, here it is. You can see the earnings chart for Boeing. It's pretty inconsistent. You see a lot of negatives here, and see that we had some grounding of some of their airplanes. People were afraid they wouldn't be selling them. We also had the pandemic where people weren't flying, and so we had like a negative here earnings. So it's not. It looks pretty good. The earnings projections look really good, but Warren Buffett wouldn't be interested in this because it's pretty inconsistent over time. I don't know. It's a really tough one to. I'd rather have something that's consistent earnings and steady demand over time with quality, better quality. Let's look at our meeting notes for here. Okay, so good management and a good product, then consistency is very important. And right now we're following Boeing, but it's turning out to be a quality control nightmare. Every year we have another problem with one of their airplanes, but this shouldn't affect their deliveries. But we'll see. They might ground this. We don't know. Okay, so we have another article here that says, "Can sizzling Magnificent Seven trade keep powering U.S. stocks in 2024?" So this article on Reuters talks about the outperformance of the top 7 tech stocks compared to the S&P. Here's the S&P down here, and look at the performance of NVIDIA and Meta and all these other ones. The important thing to keep in mind with the shares of all these Magnificent Seven stocks is they have a better earnings projections than the other stocks in the stock market. So profitability is very important, and that's one of the main reasons why I'm buying and holding these stocks and not selling. Right now they're almost all universally overvalued, but they expected to post a 39% aggregate earnings increase in 2023. That's compared to a 2.6% decline for the rest of the S&P. So a good portion of the earnings of the S&P are being made by these tech stocks. So there's a reason for them outperforming. And the earnings growth is expected to outperform again in 2024. So I'm holding my big tech stocks, and I know it could be a down year because they're overvalued right now, but still they're still growing. We're going to go over the earnings projections for each of them in the next pretty soon, and we'll see how the earnings estimates have increased or decreased over time. Here's I like to look at Twitter as every day just to get some ideas from people. A lot of times people look at charts and how things do after good years and bad years, and this guy had this he had a note that says, "Tell them when the S&P 500 gains 10% in November and December, like this year, the returns the following year get even better. So you can see that in 1954, all these years that the S&P had a good return, the final months of the year, there's the final months of the year, including this year. The January was usually a positive year, except for 2020. And the Q1 was usually a positive quarter. And the next year is usually positive. So that's another good indication that, we're going to be doing good next year. But I'm ready for a down year. If we had the portfolio we're following here is up 40% this year. So I'm ready for a 20% decline if that's what we have to sit through to hold our stocks. Okay, next little story is Dan Ives says this year we had an AI revolution, and that's being led by Microsoft, and a lot of the big tech stocks are going to participate in that, and that is going to be the next big thing. That's the iPhone moment, he said. So iPhone moment is like the year that Apple came out with the iPhone. That was a huge product cycle that they came out with. So looks like Microsoft is leading the new AI cycle. Okay, so what we're going to do right now is we're going to look at some of the earnings charts. What I did was I mapped out the earnings estimates from September of this year and December and see if our stocks are getting better or worse and whether or not we should continue following these stocks. Because this is a good time of the year to review and see if our thesis is still holding for all the stocks we're following. Okay, so the first thing we're going to do is we're going to look at, let's see, okay, there it is, AbbVie. AbbVie's getting better, the earnings estimates. This is the current earnings estimates, and I'm comparing that against the earnings estimates from September of last year. And I do that for every one of the stocks we're following. And so AbbVie is they're in a position where they have one of the best-selling drugs of all time, Humira, and it's coming off patent this year. And they're starting to buy companies in order to replenish the earnings that they're going to be losing there. So it's like they're in the process of reinventing themselves and trying to replenish their pipeline for drugs. They have a 4% dividend. I bought this stock whenever there was a pandemic, and I saw it was like an 8% dividend at the time. And now it's like a 4% dividend, but still it's a growth and income type of stock. Right now it's not growing at all because of this Humira patent cliff, but they're supposed to grow 9 or 10%, and they have a 4% dividend. So this is still a decent stock for a dividend part of your portfolio. They still have that risk where if the new companies that they're buying don't come up with good drugs, they might not do good. So that's a risk. That's a small risk. Now let's look at hold on a second. Abbott Lab. They have the thesis for this company. It's another dividend stock. We in this portfolio we have two kinds of stocks. We have growth stocks and dividend stocks. Dividends are ones that pay a dividend, and sometimes they grow and sometimes they don't. Sometimes they just yield something without growing. And Abbott is example of a stock that's growing around 8%, and it's has a dividend too. But right now its earnings are better than they were 3 months ago. Their earnings projections. So that's a good sign. For me, I bought this 10 years ago, so I'm still holding it. And it's just part of my income, part of my portfolio. Let's look at AT&T. AT&T, we've been following this. Their earnings estimates aren't growing at all. They're actually getting worse over time. but you see that they have 0% growth. I mean, their earnings are actually getting a little bit better, just fractionally better, but they're currently yielding 6.6%, which isn't that much really. They had a recent run. The good thing, the tailwind, the good things are the lower interest rates are that makes high dividend stocks more attractive. So we had this year we had utilities and these kind of stocks underperforming. So they'd be the ones that might outperform next year. So let me see. Let's look at earnings trends. Okay. So the other thing is T-Mobile is taking their market share. So they might have to cut the dividend if they lose too many customers. They might increase their spend on advertising. But that helps Apple because they advertise the iPhone on their commercials a lot. Okay, let's look at next one, Costco. They actually did better than 3 months ago for their earnings estimates. So these earnings estimates here are markedly better. They had a good earnings report recently. They're growing around 9%. The PE is still really high at 40. So I have a hard time buying a stock like this. It's 4 times overvalued. The good thing is they have a consistent user base of people that renew their membership fees, which are most of what they make. That's what they make most of their money on. So if they increase their rates they charge for membership fees, that the stock will go up a lot. And they also are growing overseas. So you can expect like this to grow 8% over time. It's a compounder. The bad thing about it is it's expensive. It's 4 times its growth rate. Let's look at next one, Alphabet. The earnings estimates are better than they were, like maybe 5% better than they were 3 months ago. So these numbers are still pretty good. This is one of the most reasonably priced big tech stocks we have right now, and it's very consistent. The good things are they have consistent earnings estimates going forward, and the bad things are they're right in the middle of litigation with the government. So we have problem with them possibly having to adjust their business model in their Play Store and to appease the government people. So hopefully that doesn't happen, but we'll see. And if they break Google up, there'll be 20 mini Googles. Would that be better or worse than one? I don't know. We'll see. Okay, Altria Group. You can see that their earnings estimates are getting worse. So the problems with this stock, every stock has fleas, or you can call them warts. The problems with this stock are that people are smoking less, and they have to make and there are bans in some countries from smoking, like in Australia. There's these rules where new 21-year-olds can't smoke, and that's a bad thing. People are they're trying to switch to smokeless alternatives. So hopefully, if that doesn't work, they'd have to reduce their dividend. So we'll see how that works. Right now, the earnings estimates are going down. This is it's one of the stocks that pays a 9% dividend. That's pretty darn good. And they're smart enough to find other ways to get people to buy tobacco. So we'll see about that. The PE is really low at 11, so their PEG ratio is pretty low. But it's kind of dangerous because people are right now switching from smoking and to alternatives. Let's see if they can get out of the mess they're in right now. Next one is Apple. Their earnings estimates are getting better, so they're actually around 10% over the next couple of years, their earnings growth. Their PE is 29, so they're 3.6 times overvalued. I do these checks. This is September, and this is now. So their earnings estimates are actually going up. They're still not growing that much at all. So we have to you have to be very cautious in buying new positions in Apple. It's overvalued right now. But I'm not selling my positions because I know they're still growing, even if it's a little bit. Let's see, AT&T. AT&T is not. They're not growing at all. There's zero growth, and there's a dividend. So I don't know. I'm not interested in this. Mark likes it a lot. Let me see. Bristol Myers. This is an example of a stock that we flagged in the middle of last year as they're not growing anymore. You can see with their earnings estimates, they're flat, and they're not growing at all, and that's pretty bad because all you have right now is a 4.69% dividend for this stock, and if they're not growing, they have to acquire companies for growth. They just bought a company this week, I think, just to help that growth, this growth trajectory. But right now, it's very inconsistent growth. You have -4%, -2%, you got 3%. So all in all, it's not growing much at all. Its PE is 15. It's really low. So PEG ratio is 7. It's growing at 2%. So this is an example of a stock. We're taking this time to not follow this anymore because it's a loser stock, and the dividend's at risk because they're not growing. And I don't know. This is an example. You have to admit your original thesis was wrong, and you have to move on to something else. And you can see the stock price is going down too. Okay, let's look at the next one. Colgate-Palmolive. Their earnings estimates aren't changing. They have a very steady demand. Look at this. The earnings are like consistently the same. So they're growing around 8% a year. The P is amazingly 41, so they're 5 times overvalued. But for me, as a dividend, all I bought it for was a dividend. So, steady earnings without negative earnings or surprises is very good for maintaining a dividend. Let's look at the next one. CSX Corp. The earnings are actually worse. The projections are worse than expected. This might be because of a recession that might be coming. But I'm holding it. The earnings estimates are still going up, and they're projected to be around 9% growth. So the P is only 14, so it's very reasonable, priced at 1.5%. But they have a monopoly. No, they're not building new railroads, so their business model is to be more efficient and to improve the efficiency of the railroads over time. Some of the problems that they have is they had a couple track times when their trains went off the track, and that's bad PR, and they had to pay something to remediate that. But that's something all the railroads have to deal with. Okay, so let's do Meta. You can see that the earnings projections 3 months from September today are much better than before. So you can see that there's a correlation. When earnings estimates get better, you see an increase in the price of the stock usually, and vice versa. Whenever we looked at some of the stocks, like with this one right here, Bristol Myers, as the earnings estimates go down, you see the lower price in the stock. That's why you have to keep track of these earnings estimates, and sometimes there's a disconnect too. Like sometimes people were totally off with Facebook down here. They thought they would be investing in the metaverse forever and run out of money. But in actuality, what they were doing is cost cutting, and that helped them to achieve profitability again. So they're growing at 14% or so, or 20%. So they have a very reasonable PEG ratio. They're overvalued maybe by 50%. No, not 50%, but they're 1.7 times overvalued. Right, and JP Morgan, they're actually better than they were 3 months. The earnings estimates are better than 3 months ago. You can see that they totally benefited from the crisis of the banks last year. They got a bank almost for free in the meltdown of the banks this year, and they're going to be better off with the interest rates going down too. So that's all in their favor. And you see, so I'm holding this as a dividend part of my portfolio. And I don't expect a whole lot of growth out of it. So they're going around 6%, and their PE is really low at 9. So their PEG ratio is 1.5. So it's close to fair value. Let's look at PepsiCo. This is one of the worst performing stocks of the ones we're following. This is part of my dividend portfolio. You can see the earnings estimates are better for next year compared to this year. This is an example of a dividend growth stock. So they're growing maybe at 8%, and they're raising their dividend, and the total return is around 11%. But this is an example of a stock that did bad this year. They're consumer staples, and they're paid a dividend, and they're primed to outperform next year. And there was a little bit of a scare that weight loss drugs could cause people not to eat burritos, but I don't think America is going to be doing that on a major scale. People are still going to be drinking Pepsi, I think. But the thesis for this company is most of their profits come from Frito-Lay and snack business. And they have that way to distribute Pepsi and right next to it the Frito-Lay. And that's a good diversification. Okay, so let's look at Procter & Gamble. They're growing around 8%. The theme for this company is that they're cost cutting. They're trying to reduce the cost of their input costs, like sugar or oil or whatever they use for their inputs. And they're trying to reduce the number of products they have so that they can focus on smaller amount of products. So they can advertise more for Tide and get rid of some of their underperforming products. So that's their theme. And they're returning a dividend of 2.5%, but the total return is around 10%. So for me, for a buy and hold, this is an excellent dividend stock that's going to continue to be in demand in 10 years. These people are still going to be washing their clothes 10 years from now and using their beauty products. So let's look at the next one, which is Starbucks. This is surprising. Their earnings estimates for the next couple years are like 10% better than they were 3 months ago. And they're growing around 15%. Their PE is 33, so they're overvalued right now. In bad times, this kind of stock would drop down 40% or so. But right now, it's overvalued. Their main growth, the main part of their company that's growing is the China overseas, because you can only open so many Starbucks in America. So let's look at one more thing. Okay, Verizon. You can see the earnings estimates are actually worse than 3 months ago. So they're really being hurt by T-Mobile, who's taking their market share. They have a dividend of 7.8%, and that's not growing at all, basically. So we have a stock right now the dividend is at risk, and you can see that another instance of a worse earnings estimates than 3 months ago, and you can see the performance of the stock went down with it. So sometimes you have earnings estimates that are better and the stock is going down. That is the time you start looking to buy. And this chart is one of the best charts to know to predict the future of a stock, the earnings over the price of the stock chart. Okay, so let's look at This is on the let me see, hold on. This is an example of a stock that would be on the possible reduce from portfolio because it's an underperforming stock. And let's look at the good thing. I guess the good thing about Verizon and AT&T are that these were underperforming this year. So these kind of stocks outperform after an underperforming year. And people, as the interest rates, people will be looking for ways to get yield. And this is an example of a very good dividend stock. That's probably one of the main reasons I haven't sold it out of my portfolio, because I've held it for a long time, and eventually it's a 7.8% yield, and it's been out of favor this year. It'll probably be in favor next year. Let's look at Visa. This is an example of one of the strongest stocks that we have that's growing around 13% a year. And the theme for the stock is they take a toll of every transaction. Even when credit is tight and bad, they take no risk. They're just a toll collector. The banks take the risk when people have credit card fraud, or they do not pay their credit card bills or go declare bankruptcy. So they've been growing at 13% regularly, and they have a PE of 31, which is pretty expensive. So their PEG ratio is 2. So they're ritzy, but they're growing steadily, and you pay more for a car that starts every morning, as they say. So, so this is an example of a stock that I'm buying and holding forever. It's a growth stock and a dividend stock. It pays 1% dividend. And MasterCard is very similar in theme. But the theme for this stock is that most of the transactions in the world are cash. And they're getting people to use credit cards around the world at a 13% rate, it seems. Let's look at Waste Management. Their earnings estimates are better than 3 months ago, and you can see their stock is actually also up, and that matches that correlation of better earnings estimates, stock price going up. The thing with Waste Management is there's a barrier to entry. You can't just open a junkyard or a place to dump trash. You gotta have industrial sized containers, and you have to follow rules. You got to get permits, and they don't get permits anymore. So they have like a moat, and they can charge more and more every year. And they have a duopoly with Republic Services. So it seems like it's a great dividend stock, and they're growing maybe 11% over time. So total return is around 15%. That's not bad, but you pay a lot for it. It's twice expensive than its growth rate. Okay, let's look at Amgen. I was surprised to see this is much better than the earnings 3 months ago. I'm not sure exactly. I haven't followed this stock a lot, but you can see the earnings estimates are like 10% more. And right now they're only growing around 3%, but the P is 17, so they're pretty expensive stock. I'll have to follow up on this to see if it's worth following again this year. It's not very exciting. It's not growing a whole lot. Let's look at the next one we're following. CVS. The earnings estimates are worse than they were 3 months ago. So you can see the stock price, kind of matches that. It's down, and the problem with this company is they have a business model at risk. They have Mark Cuban says he's selling it a little bit more than the cost in his business, and that's totally changing their business model. So Warren Buffett would not like this stock because they might not have the same business model in 10 years. So they might not have. Wall Street hates uncertainty. So if you have an uncertain way of earning money, and you have declining earnings estimates, it's an expensive stock. The PEG ratio is 5. I don't know how they're going to get out of this. but it doesn't look like they're going to outperform other stocks we're following. So because of that, I'm thinking we're going to stop following this one. Next one is Johnson & Johnson. The earnings are worse than they were 3 months ago. And I think that could be due to the cost of litigation. They're starting to split off some of their companies, so they're earning less. And they're growing 8%. The PE is 32, so they're 4 times overvalued. They have declining earnings estimates, possibility of litigation risk with talcum powder lawsuit. This is an example of a stock that has warts, and is it worth it to have a dividend with the potential of it going bankrupt? I don't know. I'm not smart enough to answer that, so I think we're not going to follow this one either after in the next year. So that was good analysis for that. Okay, Walmart. Walmart is still growing. It's better earnings estimates than before, and you can see the stock is up from the last time we checked the earnings estimates. So it's basically a 9% grower. It has a small dividend of 1%, and its PEG ratio is 3, but it's very consistent earnings. And they survived the pandemic with flying colors, and they have a robust business model, and they're trying to get into Amazon's idea of buying things online. And so they have a parallel business model with Amazon. Let's see if they can execute that. Costco was doing really good with their memberships. They have a Sam's Club, so that's a parallel to a good business model at Costco that works. So we're still following this, and I think it's a good growth dividend stock. It's a little expensive right now, but it's a good one to follow. Tractor Supply, their earnings estimate are worse than 3 months ago. The stock hasn't gone anywhere in those 3 months. So I don't know. It's growing around 9%. PEG ratio is around 2, so it's overvalued. The theme for this stock is that they have a niche in rural farmers in the local market for grain and things. You can't buy grain for your cow at Walmart, so they have a very good niche there. I'm not sure how they handle how they work in a recession, how good they'll do. So I'm not sure about this stock at all. It looks like it's still growing, but it's a little bit expensive. Let's look at Berkshire Hathaway. Earnings estimates don't go out that far, only 1 year. That's because people don't understand the stock very well, and they're too lazy to go through and understand, the estimates. So you got to trust the Warren Buffett on this stock. It's growing. It's grown around 10 to 20% a year. I'm not sure, but Warren Buffett goes by book value, and he compares, the value of the stock based on book value, and that has been going up around 15% a year since the 1960s. So it's still growing. We're still going to follow it. It's pretty unchanged earnings estimates from 3 months ago. It's around fairly valued, but it's really hard to value, in our traditional metrics. Let's look at eBay. eBay is basically unchanged earnings estimates from 3 months ago. It's not growing a whole lot. This is an example of a stock I think we're going to not follow anymore. It's only growing at 6%. PE is 17, and the PEG ratio is 2.8. So I think this is a good one we're not going to follow anymore. It's has a lot of competition with Amazon right now, and it's not really growing much anymore. So let's look at the next one. Boeing, we already talked about this one. I'm afraid to look at stocks that have negative earnings at all, and right now they're starting to get profitable, but how long is that going to last? Until another airplane is grounded. I don't know. So that's the problem with this stock. They can't make airplanes fast enough in a quality way. So let's see if they improve their way they make their planes. The interesting thing about NVIDIA is they're better. Their earnings estimates are a lot better than they were 3 months ago, and they've gotten cheaper, believe it or not. So that right now, this is their earnings estimates 3 months ago. Now their earnings estimates are 368% year over year, 40% next year. Then they don't know what's going to go on. But that means the PEG ratio is 0.5 right now. That means they're half undervalued. Their PE is 26, and they're growing around 40%. So that's a big change, because it used to be, the PEG ratio used to be 8 with the PE of 111 with good earnings. You can see the stock is following the earnings. If you have better forecast, the stock goes up. So that's another example why it's not a good idea to necessarily sell out of big tech stocks, because this was actually getting cheaper over time. Nike is worse than 3 months ago. You can see the stock is kind of going down. That kind of matches, but it's still growing around 10%, and it's expensive right now. It's double the price it should be. And Ford is floundering around. This is an example of a stock I think we're going to stop following. You can see that their annual earnings estimates, they're not growing at all. It hasn't. It's getting worse. The earnings estimates are getting worse. Their dividend is at risk. The United Auto Workers are causing them to lose $1,000 more per car, and they have to renew that contract again. And who knows what they're going to charge for their rates next time. This is becoming a very unreliable stock, and they're getting worse over time. So this is an example of a stock we're going to cut loose from our portfolio and not follow it anymore, because it's very hard to make money in cars if you're not Tesla. And that's why their PE is really low. Car companies usually have a PE of 5 to 10 because they don't grow that much. And there's a high input cost, and it's hard to pay people and to make things that are going to sell, cars that are going to sell. So it's a very challenging, and Tesla is actually kind of undercutting their prices. So they have to charge less for their cars, and they're not profitable at doing it. So it's just the situation I don't want to be in. So we're not going to follow this one anymore. That's it. So I think that's it. Okay. So I think let's make sure I have. Okay, that's the end of my meeting notes. Thank you very much for attending. I hope you have a good weekend and a good happy new year, and I'll see you next time.